and good morning, everyone. Thank you for joining this week's episode of ATRAM's webinar series. Today, we will be doing an economic briefing in hopes that this will give us more insight and updates on the pandemic's effect on the Philippine economy. I, Bel Marquez, Business Development Manager at ATRAM, will be your host for today. We would like to make today's episode as engaging and interactive as possible. So please stay tuned as we will have our live Q&A session at the end of today's presentation. At any point during the discussion, however, you may submit your questions by clicking on the Q&A button found on the bottom of your screens. In addition, I would like to mention that this webinar session will be recorded. Copies of the webinar will be sent out to your registered email addresses and will be also posted on our social media pages later on. We also hope that you could stay tuned in until the end as we will be wrapping up with a quick feedback form. In the next few weeks, we are expecting several government agencies to release important economic data which will define what the outlook and prospect of the Philippine economy will look like. Additionally, we will be hearing companies release their third quarter corporate earnings numbers. In anticipation of those announcements, this morning's session will aim to share information on how the pandemic affected the economy so far, what our views and expectations will be, and more importantly, provide tools and economic insights that may help you individually or your respective business organizations. So we are privileged to be joined by our speaker today, Mr. Mari Lacson, Jomar as he is known to us his colleagues. Jomar currently serves as the head of macro and sustainability research for ATRAM. Prior to this, he actually served as the head of equities research. Jomar has over 20 years of research experience in equities, finance, and economics, spent with various global and local institutional securities brokerage firms. He enjoys sharing his experience and expertise in these fields as a university professor and also as a PhD candidate in economics. Please help me welcome Jomar Lacson. Hi, Jomar. Thank you for joining us today and trust all is well with you.
Yep, everything's fine here in the house. We
Good.
are still on a work from home situation.
Yes, indeed we are. But great to hear everyone's safe. And without further ado, Jomar, the floor is yours.
Okay, thank you, Belle. So good morning, guys. Welcome to our weekly webinar. We continue to hope and pray that you and your loved ones continue to be safe as we traverse through our 31st week of community quarantine. Today, I'd like to talk about economic scarring. So this concept has been around for some time, but back in June, there was a working paper published by the National Bureau of Economic Research in the US regarding economic scarring because of the pandemic. And since then, this concept has slowly entered into the list of emerging ideas or jargon in relation to the pandemic or the ongoing global economic crisis. Now, with reference to economic scarring, actually, the Philippines is in a unique position because we have so much experience to share on this particular phenomenon or long-term risk. I'm going to take a sort of like a short trip through Philippine economic history just to remind us what we know about economic scarring and how we've managed our own crises or set of crises to strengthen our macroeconomic fundamentals. Yet, even with these positives, the positive fundamentals, we still need to acknowledge in this briefing that the future is largely uncertain, particularly in terms of firm or individual behavior. So this is the other point that I'd like to talk about today. So what will be the behavior of both firms and individuals with regard to investment and spending once we exit the quarantine stage and proceed towards the recovery strategy or recovery phase of the government? These are the big questions for both the government and the private sector. And speaking of the government recovery strategy, we're now approaching this particular part of that phased approach to the pandemic. We're not there yet. But the stimulus and other like related policies will be the cornerstone of demand going into 2021. I'd like to touch a little bit on this later. So what's economic scarring? So this is the definition really. It's damage, economic damage. That follows once you experience an economic shock, like a recession. Um, but it's not a short-term thing. It's a medium to long-term kind of damage. Now, if we're going to look for economic scars following that shock, there will be like these four. Parang I would say symptoms. Okay, the first is actually a drop in investment spending. So we're not just talking about a short delay here. Okay? We're talking about a sustained deferment of your maintenance capex for fixed assets, such that they actually depreciate, not just maintaining it, but you're depreciating already. And when we look at it in terms of the balance sheet of both companies and the economy, it will actually shrink. The second point is it's not just about the physical assets or the physical capital, but it's also about human capital. If we're no longer investing in human capital, and this will result in high unemployment that will prevail for significant amount of time, or maybe even if we reduce our investments in training and development, this also has an impact or an economic scar. And if we move along, the economic crisis actually wears on. We may see business failures and significant bankruptcies happening. Doesn't have to be the whole system that will go bankrupt, but just big ones that can happen. And the last symptom uh, that when these bankruptcies happen, it actually cripples the financial system. It reduces the capacity to reduce credit, or sorry, to reduce credit available to firms and individuals, such that they cannot borrow to invest or to get themselves out of the rut that they could be in already. So does this sound familiar? So this is a chart of our GDP growth for the Philippines since we got our independence from the U.S. And as you can see, had several uh, economic crises for the past 40 years. But I'd like to highlight the one on the debt moratorium caused by the debt moratorium of the early 1980s, around 1983, that ultimately, as we all know, culminated in the 86. It's a revolution that changed the administration. Now, this was a picture of an economic collapse. So in this chart, I've also included our own forecast of a 9.2% contraction at the tail end, and I've highlighted in red marks the ones that we've had sharp dips in our GDP growth. But the ones that are sharpest are the 83, 84, and today. It's if you look at our forecasted contraction, it's much sharper than 83, 84. But are they the same? Should the results be the same? So I hope you don't mind if we take a step 40 years back, um, which some memories may not be. A good portion of the audience may not have been born yet. Know a couple of these references, but I hope you don't mind. The 1980s recession produced substantial economic scars, and we know this because one, we've never upgraded the jeepney. It's still the basic 1940s design, and up to now, we still have jeepneys that are probably in excess of 20 years of age. So we didn't really invest in this. In fact, when I was looking at it, Sarao, which is like the main manufacturer of jeepneys, has an estimated production capacity of around 4,000 units annually, and that's like 1/4 of the vehicle sales we have in a single month, at least in pre-pandemic. So there that in that area alone, physical assets or the fixed assets haven't been moving. And back then, our mass transit system consisted of buses. So the LRT was really born around this time, but the government was a major player in the transport industry with the iconic Love Bus, which is the one of the bus in the picture. But after the revolution, the government couldn't maintain this because, of course, we were still in a precarious fiscal position, couldn't really borrow externally. And eventually they sold this franchise, I believe, to, if I remember my history right, to DMCI. But it, for some reason, it never returned to its old fleet and eventually disappeared. And during this time, we actually had a bus shortage and not a road shortage along EDSA. To cover the shortage, we allowed importation of surplus buses from China for a while, and obviously we know that the quality of that, what we were getting, but it addressed the transport capacity shortage, at least in the 90s. But I guess the point is we didn't invest in mass transit fixed assets for a while. No? It took us some time. The MRT eventually came in, uh, but at a high cost of capital. We also saw unemployment climb up to digit levels. If we're looking at I was looking at the data back in the 80s. We were still doing about 4 or 5% unemployment rate, which is actually uh, not as good as what we had prior to the pandemic. But as it was climbing up to close to 12%, um, the administrations of those during that period set, I guess, set or allowed the policy of letting Filipinos leave. Hence, we have this OFW phenomenon that, in many ways, is sort of providing us the support. And lastly, we did have also a banking crisis, no, with the impact of these scandals. So I barely remember the details, but there was a DWD scandal and even Banco Filipino, which was closed down, opened up, and I think in more recent times closed again. Uh, but the recession's main impact in the 80s was really uh, lending was restricted because there was a spike in the cost of borrowing to over 30% with the issuance of the so-called Jobo bills under the central bank governor, the late Jobo Fernandez. So with interest rates over 30%, no, firms preferred to save rather than invest, and lending costs would be prohibitive for a time. You'd probably have these government guarantees just to get everybody, to invest. So it covers all the four symptoms of economic scarring. So we know that economic scarring was clear during this period. And now I'd like you to take a look at this, at our gross international reserves. And this is the RGIR, or dollar reserves, over since the 1960s. And uh, it gives us two sets of data: the dollar reserves and the year-on-year change. And you can see that the changes reflect the volatility of our dollar reserves over time. And the most volatile periods of our GIR were really during, well, let's say, far back as the 1960s. But the ones that mattered the most, I guess, was during the 1980s, wherein you can see that small blip here that surpasses the whole range. This one, I think that this was really a change, no? During the 70s. But I can explain more on this one, wherein our volatility started getting right after that particular period. We started to stabilize. So the most, as you can see, though, during these periods where our dollar reserves were volatile, we were experiencing weakness in our economy. Particularly due to the crises over the past 40 years. Probably the only exception is the 2009 crisis, which arguably we came out relatively better than other economies. I guess the argument here is that, if we're studying the allocation of scarce resources, as we would define economics in the past, then we can say that the dollar, or the US dollar, was our scarcest resource before. And if we do not allocate or manage this properly, we can go into an economic crisis that could be bad or long enough to do long-term damage. And I think that's not the case today. Our GIR is currently at the highest level at over $100 billion, and its growth, the stability, has been fairly good over the past 10 years, at least relative to the more volatile decades that we went through. So what's driven the our dollar serves to such high levels amidst the pandemic? Well, the current account has shifted to a surplus position, and remittances actually, people were very worried initially with the contraction of the pandemic already going on a global scale. Well, remittance actually fell less than what we initially expected. Back in May, we were looking at a 5% contraction. And on a year to date basis, uh, the remittances have actually declined about 2.6%, if I'm mistaken. And we have our own expectations, but it will not be less than 5% by our estimates. So if you look at this, it's a combination of a weak dollar demand and a relatively stable flow of dollars from overseas Filipinos, plus uh, borrowings from the government. As the government draws down from its borrowings from either ADB or IMF, this also contributes to the dollar flow into the system. So I've seen some reports that may question the quality of the rise from 50 billion to 100 billion, but when you look at it from a volatility perspective, we should look. I think we should look at GIR management in a positive light. At least this is one thing we know, that we have sufficient dollars, and the flow is fairly consistent. Which brings us to the second point. Since this is one thing we know, what do we not know? How will the private sector behave? I mean, going forward, once we go to 2021, well, we can see at least with the latest data that manufacturing is recovered or is recovering a bit. And we also know that the community quarantine has affected some sectors more significantly than others, no? Particularly transport, recreation, and culture, and restaurants. These are the big reds in the table to the right. So the question, I guess, is these sectors, they're the hardest hit. How will they react after the quarantine is fully lifted? So as we enter this data heavy month, these are the questions we have in mind, or on our mind. Will firms be deferring maintenance capex? Will consumers still avoid travel and eating out? Will firms refuse to hire back its workers? Clearly there's some sort of interdependencies in these questions. So, but these are just the curiosities that we have, how the dynamics will work. Um, because by answering that, I think we have a fair idea of the probability of, or even the extent of economic scarring if it does happen. So I'd like to show two charts, no, and share some sort of my thoughts on this one, how they'll behave. So I guess one of the concerns that we have from a macro perspective is on the firm side. So this is a chart of the leverage or the debt to equity ratio on the left slide of the PSEI, um, and the current ratio is on the right. So when I look at these charts, I just find some reason that the private sector might actually hesitate a bit to go out there and either raise capital or deploy capital. It's the leverage and liquidity ratios are not unhealthy. In fact, they're okay. But when you look at it relative to the low for debt to equity ratio and the high for the current account ratio for this particular segment, it's higher for debt to equity ratio, and it's lower for the current ratio. So will the private sector be comfortable at these levels to deploy or raise more capital in 2021? So that's one of the I guess the questions that we have when you see this kind of data. But recent events also make me think that it is possible that he will not hesitate. You know, uh, this week, Robinson's Retail just made a big acquisition with Rose Pharmacy. And while it's just one data point, admittedly, it reveals that the risk appetite of cash rich firms um, remains healthy despite the present economic contraction that we're experiencing. Which brings me to another point about the economic scarring. Such events or developments is really a disruption. No? Disruption is not necessarily scarring. So acquisitions like these represent disruptions to industries, whether it be like a work from home disruption in the telcos that, or maybe affecting even the office residential sector, or in this case the pharmacy, because there's some form of consolidation in the industry. But this is disruption. So what economic scarring is really about is persistent behavior, persistent disruption, and persistent damage. Okay, so that's what we kind of are gonna have to be on the lookout for when we are assessing economic scarring from the pandemic, or from the quarantine actually. So what can go wrong? So this is sort of like a diagram of our framework, how we're looking at it. So there are sort of like three elements to the recovery, namely the stimulus, the transmission, and the incentives. The stimulus is, I guess at this point, it's the least of our worries, because the Bayanihan 2 is already there, it's ready. The budget for 2021 was a bit in trouble for a while earlier this month, but it's now with the Senate. So barring any major cuts, this should be, I guess, a go as well. But stimulus would mean nothing if the transmission mechanism is still shut, which is the quarantine itself. So our assumptions are counting on a move to MGCQ by December, based at least on our base case. This could still change, of course. I've seen some recommendations by the IATF for GCQ all up to December, or maybe there's even a spike in infections that might change the policy. But for now, I think the data says that relaxation of the quarantine, is possible by December. But in this framework, the unknowns are the incentives. So we still have create, FIST, guide, and some bills that sort of like unlock or at least reduce the foreign ownership constrictions in certain sectors. No? So if passed, we believe this will encourage the private sector to match the stimulus by, I guess the government will be able to reduce at least the risk, financial risk involved in investing, may even provide some equity support, or capital support rather. And they know then there's possibility of introducing competition to a sector that might be more amenable to grabbing an opportunity. When we see headlines like these, we also believe that the economic scarring scenario can be avoided. No, infrastructure is a major form of public-based capital. So the development of an airport, the railway, even the reduction of traffic on EDSA with the Skyway 3 being opened, can reduce the cost of doing business for several sectors, which is why the fiscal stimulus matters the most, at least in the near term. If it does happen, it allows I think it will allow the private sector to achieve that confidence level to start, investing again. So we conclude with the sort of following thoughts. So our economy can be argued as a being battle scarred. We have lessons that our central bank, our corporates have learned already from the past, and this is I guess a key difference heading or going into this present crisis, which will allow us to navigate these in a safer mode. But getting out of the crisis can be trickier. Private sector can be too risk averse, that they divest or defer spending despite the positive points of the economy. Hopefully, their preferences, as we would describe behavior in economics, would be less sensitive and be motivated by a more stable return on their investments. With the government providing both the environment for less risk um, and stimulus for to increase demand. Our forecasts factor already the government spending, and to a certain degree, a slight risk aversion of the private sector in order to get back to the 2019 levels. So, if the private sector kind of reacquires its confidence level with either a pandemic solution like a vaccine, or maybe even the stimulus works better than expected, then this represents the upside to our um, 10.9% forecast for GDP in 2021, potential upgrade for GDP going forward. So that's my last point. Thank you, and welcome questions from the audience.
Thank you, Jomar, for that very informative and comprehensive presentation. As expected, when it comes to economic briefings, there are always a lot of data points to digest. So, just to remind the audience, we see a few questions coming in, but you can still keep asking your question using the Q&A button on your screens. So, Jomar, let's go straight to a few that I see came in. Um, Guess you discussed briefly about MGCQ being our base case in December. So, an audience asked, what are the real implications of an MCGCQ status to businesses and the economy? And will it be significantly different from current situation, which is GCQ? And how will that affect any of the forecasts that we hinted on and mentioned earlier?
Okay, thanks. That's a good question. Um, with respect to MGCQ, what we've done with the forecast is because our analysis is that the quarantine, the mobility restrictions forms a supply shock. The demand shock is the unknown. We don't know yet how demand will react uh, once the restriction is removed. So we've approached the our growth assumptions from a supply shock perspective. And moving from MGCQ or from GCQ to MGCQ means that the government is doing it on a per sector basis. The last to go, I believe, under an MGCQ will be the hotels, restaurants, and the transportation. So these are sort of the last sectors um, under sort of the last to be relaxed in a sense. So because the policies are really aimed at restricting, a aggregation or create some density in spaces. So our assumption is that on a percentage basis, how much do you relax from each? The GDP growth for 2020 can be as low as best case is about 5.1%, and 11%, I believe, for the full year. Um, Under a worst case scenario. But I have to qualify that also has an assumption on spending of the government, because it's a critical part, at least in the short term. How much is the government spending by relaxing as they spend? So as they relax, they also have to spend in order for the multiplier effect to be there. Um, so that range that we have, our base case is 9 for 2020, and best case was 5.1%, and I think the 11% contraction as the worst case. Now our base case, if we put it relative to the forecast out there for 2020, I think the central bank has the closest at about 9% on its I guess that's the worst case, between 6% to 9%, and the DOF is looking closer to about 6% GDP contraction um, for the year. But in general, it's this contraction that kind of drives that. Sorry, the restrictions drive the magnitude of the contraction.
Thank you, Jomar. That's clear enough. So, I mean, in relation to, I mean, you mentioned infra and obviously construction. So, lots of listed companies actually in that sector. And so, with the 3Q corporate earnings coming out for private for public listed companies or even private, do we have expectations at what level they might be at?
I think the following the second quarter earnings, um, our current expectations for the full year, at least, is a 41% decline in the PSEI uh, earnings per share. So that's our current expectation. So it's just the earnings season has already begun. BPI has already put in its has already released its earnings, and we're still digesting through the earnings release of BPI. If I'm not mistaken, it's a 38% contraction for BPI. But then again, remember there are some companies that actually are less affected less by this the quarantine. So it coming from the second quarter, it really has multiple drivers for the earnings. But that's our expectations, about 41% contraction for the year.
Okay. Jomer, I see a question here on OFW remittances. So, are you expecting OFW remittances to be better or worse on the next sprint? And what would be the implications if they come below the consensus or expected range or higher? Because as like last quarter's release, it was higher. So, I mean, what would be the implications if they go either way?
For OFW remittances, it's like as I mentioned a while ago, it's 5% was our original estimate, a contraction of 5% to about our remittances is about $30 billion annually, and 5% would put it around $28 billion, and the our estimate is about 3.6% contraction. The reason for this is because it's going to be a bit will move up and down over the next few months, because we already had the August data. So we have about 4 more months of remittance results to anticipate. But uh, December was a particularly strong month. It was close to $3 billion. So we have to expect some contraction on that. It was a pretty high. So like I'm saying that it's going to move up and down. There will be bigger contractions. Like for example, in July, it was a 7.3% increase. But when it came to August, it was a contraction of about 4.1%. So we have to expect that. I think what's more important for us is that we've set sort of a threshold. We believe that there's really this about 40% of our remittances come from the US, and that's growing. In fact, it's about 9% growth in remittances on a dollar basis coming from the US despite the crisis. So this is sort of like the a core remittance source uh, for that will be there even in a more critical period. There are some I guess OFW areas that are contracting, like the Middle East and Europe. But so far, there are other areas that are actually compensating. So even that's the reason why the initial estimate was that it will be a really a global contraction. But it seems that there are some areas that are still growing. Uh, primarily, I think it's because they understand that the beneficiaries here in the Philippines are also being affected by the stronger peso, and they also have some requirements, and that's why they need to send some money home. It is possible that a good portion in the July data is due to the repatriation of OFWs. But we've seen as long as the OFW remittances are above 2 billion, between 2 to 2.5 billion dollars per month. I think that's the solid core remittance flow that we can expect.
Okay. Well, in relation to remittance, which is one of the four, well, an audience said one of the four strong economic pillars, among other things. So that's OFW remittances, personal consumption, export, and BPOs. So an audience asked, what is your analysis of how they will perform in the next 6 months to 1 year, even without the vaccine?
Okay. So I think I've answered a bit yung on the remittance. I think
Correct.
it's as long
Yes.
as we're in that level, I think
Mhm.
it can support the portion on personal consumption. Now, personal consumption, our expectations here is that as far as food is concerned, in the basic food items in the basket, we're still seeing growth. It's single digits, around 1 to 2%. That will be there because even if you have no income, you will still eat. And I think one of the reasons for that is because, for example, we've seen that unemployment had improved. No, we had the peak in uh, in 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 April of 17%, and then we improved to 10%. And a good component of that is a move to the agricultural sector. Our interpretation here is that if you lost your job in the urban areas, you move back to your homes in the rural areas, and maybe work for food rather than for income. So there will be still some consumption because some incomes are still stable in these areas. Um, so that component will still grow. The discretionary items, as I mentioned, like the transportation, those are the most affected, and they're really highly dependent on the quarantine restrictions. That's why we believe that as the restrictions are lifted, we will see that recovery, not in full. So we're actually anticipating that about 80% of it will, if the behavior, the stimulus is on time, then the consumer discretionary component of personal consumption can recover to about 70-80% for next year with those assumptions. Now, on
That's
the
good.
last pillar on exports and BPOs,
Correct.
I think exports are really determined by the demand. I think it's a bit more difficult area to ascertain because um, where we participate in the export sector, um, at least on the electronic side, um, it's a bit limited. So if you look at our balance of trade, it tends to be just matching the import side, or just providing the labor. So I'd rather look on BPOs. And I think based on our discussions with property research uh, groups, is that BPOs continue to be there. What's the office space that has sort of been vacated seems to be coming from the POGO side, but some of it has been taken up by the BPOs. So for me, the interpretation there is that the BPO demand continues to be supportive. Um, Barring of course any, but yeah, it just remains supportive at this point, where we don't see any indicators of them uh, leaving at the moment. But what the concerns are, of course, are with the tax reform that's coming in. So we'll just have to see once the create has been passed, on how that particular sector will behave in relation to the incentives provided.
Right. That's a lot of information, Jomar, and obviously, as you said, there are some sectors who stand to benefit. There are some that might be, lagging. So I guess just to wrap up the session, Jomar, in a nutshell, and the final audience question is: is the Philippines recovering? So
Okay, I think we are approaching the phase on where we're going to implement the recovery. The main message that we have here really is that um, economic scarring is a possibility. It's still there. That's a scenario that we should always be on the lookout for. But the current the 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 main driver of our economic scars in the past has been really on our insufficient dollar reserves that will enable us to like have stability, price stability, whether it's in currency, in our inflation, in our wages. Well, these are the economic prices, and the volatility there has mostly come from insufficiency or inadequacy of our dollar reserves, which at this point is adequate, and therefore we are entering the reco- if we enter the recovery, we are in a much better position than we were back in the 80s. And maybe we can reduce, if ever there's any economic scarring, it won't be as much as what we've gone through over the past probably 40 years. Um, but the recovery itself requires the three elements: the stimulus, the transmission, and the incentives. So we only have one that I think we can say that most probable that we're the most available or the present ingredient entering into the recovery stage, which is the stimulus. We still have to wait for transmission and incentives to to happen. So maybe not, but we're getting there.
Right. At least we have one stimulus.
Yeah.
So I think on that note, Jomer, I think we can leave it there for this webinar. Really thank you for your time and as well as the audience for the questions. A lot more came in. We'll get back to you maybe on a later time. So may I also plug? I think it's a great opportunity to mention that we will be holding also a year-end outlook webinar session sometime in December with our CIO, Mr. Phil Hagedorn, and also a 2021 outlook early next year. So there are more opportunities to learn about how we're doing and constant updates on that front. So, so should you have any further questions or want to raise your questions earlier that we have not been able to brought up, so please get in touch with your ATRAM relationship manager as well as find out more about ATRAM's funds and strategies. You may also visit our website www.atram.com.ph and drop us a note there. Lastly, we would like to invite you to answer the survey at the end of this session as your feedback continues to be of value to us. So we appreciate you taking the time to join us today. And on behalf of ATRAM, I would like to wish for your and your loved ones continued good health and safety. Thank you very much and see you again on our next webinars.